A $3,500 home insurance claim can cost more than it pays back once underwriters finish the math. Not because the insurer is penalizing you, because of how the underwriting math works, and almost nobody explains it to homeowners before they press submit. I have spent nearly a decade reviewing residential insurance files. I have seen that calculation play out hundreds of times, and in most cases, the homeowner had no idea the numbers worked that way. 3 numbers: the surcharge percentage, the years on record, and the compounding effect when a second claim follows the first. And that third number, the compounding effect, is the one that can turn a manageable situation into a non-renewal notice. By the end of this video, you'll know exactly how underwriters calculate the true cost of a claim and what to do with those numbers before you decide whether to file. Let's get into it. Most homeowners assume the cost is manageable. Here is what actually happens in underwriting. When you file a claim, 3 things change simultaneously. Your risk surcharge increases. Your claims record follows you to every insurer for 6 years. And your renewability, not just your premium, becomes subject to review at every renewal within that window. Most homeowners only think about the premium increase. They do not think about the record. And they almost never think about what happens if a second claim follows the first, while the first is still on file. These 3 numbers, let me show you how they work. Number 1, the surcharge percentage. When you file a claim, your insurer applies a claim surcharge at your next renewal. In Canada, the typical surcharge for a first property claim ranges from 10 to 25% of your annual premium, depending on the insurer, the claim type, and the claim amount. On a $2,400 annual premium, a realistic figure for many Canadian homeowners, a 15% surcharge is $360 per year. That number stays on your file for 3 years at most insurers. Some apply it for the full 6-year claims record window. Some taper it, full surcharge in year 1, reduced in years 2 and 3. But here is the calculation most homeowners skip. You filed a claim for $3,500. Your deductible was $2,000. Your net recovery was $1,500. Your surcharge over 3 years at $360 per year is $1,080. You are already close to break even. If the surcharge is 20%, $480 per year. Over 3 years, that is $1,440. You have now paid back more in surcharges than you recovered from the claim. This is number 1, and most homeowners never run it before filing. Now, number 2 is where the math gets significantly worse because the record does not just follow you with your current insurer. Number 2. The 6-year record. In Canada, insurance claims are shared across insurers through industry reporting networks. When you file a claim, it becomes part of your insurance history, accessible to any insurer who quotes you for the next 6 years. This means that switching insurers after a claim does not reset your record. You take the claim with you. The practical consequence, if you file a claim and then shop for a better rate, every insurer you approach will price your risk with the claim on file. The market-wide premium comparison you run after filing is not comparing your pre-claim risk profile, it is comparing your post-claim risk profile across multiple insurers. In some cases, the post-claim premium at your current insurer is actually lower than what a new insurer would offer, because your current insurer has already priced in the claim, while a new insurer prices it fresh with no loyalty offset. What you can do: before filing any claim, ask your broker directly. How will this claim affect my options with other insurers if I want to move at renewal? A good broker will give you a straight answer. That answer is part of the true cost calculation. Number 3, the compounding effect of a second claim. This is the number that changes everything. And it is the one almost no one talks about. If you file a second claim while the first is still on your 6-year record, you are now a 2-claim file. The underwriting assessment is not twice as cautious, it is significantly more cautious than that. Here is how it works in practice. A first claim triggers a surcharge and a review flag on your file. A second claim within 6 years triggers a different category of assessment entirely. At many insurers, 2 claims in 6 years moves your file from standard underwriting to an enhanced review process. The questions change, the options narrow, the surcharge on a 2-claim file is not 15% plus 15%. It can be 30 to 50% of your annual premium. On that same $2,400 annual premium, a 40% surcharge is $960 per year. Over 3 years, that is $2,880 in additional premium. And in some cases, and particularly if the second claim is water damage or liability, the enhanced review results in a non-renewal notice rather than a surcharge at all. I have reviewed files where a homeowner filed 2 legitimate claims in 4 years, both fully covered, both handled correctly, and received a non-renewal notice at the second renewal, not because they did anything wrong, because the underwriting math produced an expected loss ratio the insurer would not accept. This is number 3. And it is why the decision to file a second claim, while the first is still on file, requires a different calculation than the first claim did. Here is the reframe. Insurance is not a savings account. You do not get back what you put in. It is a risk transfer mechanism. You pay premiums to transfer the risk of a catastrophic loss you could not absorb. The claims system is optimally used for claims that would genuinely threaten your financial stability if you paid out of pocket. Not for every covered event. The homeowners who consistently get the best outcomes from their insurance are the ones who treat their claims history as a financial asset, not a transaction. They protect it. They use it when the math justifies it, and they run the numbers before they file. That is what these 3 numbers give you, the ability to run the math. 3 scenarios. Here is how the math applies in each one. Scenario 1, small claim, pay out of pocket. The claim amount minus your deductible is less than twice your annual surcharge. Run this number. If the net recovery you receive back from the insurer is less than what you'll pay in surcharges over the following 2 to 3 years, pay out of pocket and protect your record. Simple rule. If the amount you recover is less than about 1.5 times the surcharge you expect to pay, think very carefully before filing. Scenario 2, large first claim. File, but manage the record going forward. The claim amount significantly exceeds what you could absorb out of pocket. File the claim, but immediately treat your record as an asset to protect. Do not file another claim for minor or moderate damage for the next 6 years if you can avoid it. Your priority after a large claim is clean record management. Scenario 3. Second claim within 6 years. Consult your broker before filing. This is the scenario that requires the most careful calculation. Before you file a second claim while the first is still on your 6-year record, call your broker. Ask them 2 questions. Question 1. How will a second claim affect my surcharge and my renewability at this insurer? Question 2. If I pay this out of pocket, What is the realistic cost? And does protecting my record from a second claim justify that cost? In most cases, the broker can give you meaningful guidance on the first question. The second question is your calculation to make. But now you have the framework to make it. 3 numbers, the surcharge percentage, the 6-year record, and the compounding effect of a second claim. Run those numbers before you file, not after. The claims process is frictionless by design. It is meant to feel like the obvious next step. The math is what most homeowners never see until the renewal notice arrives. And if your premium has already gone up after a recent claim, the best thing you can do is compare what other insurers would charge for your current risk profile. I've put a link in the description. Takes 3 minutes. If you found this useful, subscribe. I publish one of these every week. Everything I cover comes from nearly a decade of working inside the Canadian insurance industry. Previous videos are linked at the end. See you next week.